Meditators, welcome to another episode of the Market Meditations podcast. Today we have with us a really special guest that I've been trying to get on for the longest period of time, and it's finally happened. We have Ryan Selkis on the Market Meditations podcast. He is a true OG in the space, former director of growth at Digital Currency Group, and founder CEO of Messari. Ryan, thank you so much for joining me.
Thank you for having me. Excited for the conversation.
Likewise, I'm so excited to talk about your infamous thesis, which I've been talking about on my newsletter, YouTube, and pretty much every platform we have from the moment it released. It is incredible, especially anyone who's looked at the 2021 thesis you wrote and seen how it's managed to unfold over the year and how many predictions managed to come true. But before we get into that, Ryan, what is your background in crypto? How did you get in? Can we give people a little introduction, although I suspect most people know who you are, for those who don't?
Sure. So I got into, I started my career in venture capital, have been either building or investing in startups basically from the day I got out of college. I figured out pretty quickly that I was more inclined to be on the building side versus the investing side, and ended up starting my first company at 25. Wound that company down, which is a longer story, after about 2 years, and just so happened to have invested a little bit in Bitcoin that summer. This was 2013, so I basically went down the rabbit hole that fall, figuring out what I was going to do next, and sure enough, got the Bitcoin bug early and decided there was basically no credible information or reliable news source at the time, and I started just writing a daily newsletter that ultimately was picked up by, I'd say, the couple hundred executives, investors, and I call like professionals that were day to day and really active in the industry at that point. Through that, I built a pretty solid early network and got my hands on the Mt. Gox bankruptcy documents in early 2014. Broke that story, and then basically, the newsletter itself, my audience and just kind of general interest exploded. So was able to get to know Barry Silbert at then Second Market, as he was considering thinking about building Digital Currency Group and kind of pivoting his old company just to focus on digital currencies. Joined that fall and was employee number one, kind of part of the founding team that rebuilt the kind of core of Second Market into the core of DCG. As part of that, I was doing seed investing, helped recruit the core team. We raised a round in 2015. And after that first year, went back to the operating side of the table when I led the acquisition and restructuring of CoinDesk. Ran that business for about 18 months, got it to profitability, and then kind of left the summer of 2017. And I started Messari late 2017 to basically build the proverbial Bloomberg for crypto as an asset class. Comprehensive data and research aggregator that was going to help people navigate Web3 and really understand not only how to invest in this economy, but how to actually integrate with these protocols, and as a full-time participant, how to parse fact from fiction and make sure that we were smoothing out information asymmetries and just bringing more credibility to the asset class in general. So I've been doing that ever since. It's been 8 years, but that's 8 dog years, I guess, given how fast crypto's grown during that time period. Since then, Messari has grown to about 60 people full time. This year's been a good year for us, along with most other companies, I think, in the space. We're continuing to grow and grow our product offering. So excited to dig into that and chat more about 2022.
Likewise, excited. Thank you for that introduction. There's quite a few things I want to dive into from what you've said. Starting with, you mentioned very early on, building. You realized you were more for building than investing. What does that mean? Why? How did you notice that?
I think it's just where my interests lie. And I think having that mindset of an investor and kind of that toolkit to be able to understand the key value drivers of a business, particularly a startup, understand, financial analysis, to understand the difference between like public market equities and how you would value them versus, seed stage companies where it's basically just like founders and ideas, and kind of developing this mix of skills, both qualitative and quantitative. I feel like that has never really left, and the businesses that I've run that have been successful have had an information component to them, right? So I think being the primary buyer of some of the tools that I wanted to build as an investor, I think has really kind of helped inform direction, and it's led to the success on the building side. But I don't think it was a conscious, like, premeditated decision, when I was like right out of school versus really just enjoying the kind of iterative rewards of being able to put in a day's worth of work and seeing like real tangible results on the other side of it. It's not the same in investing, especially if you're doing like later stage investing. If you do 1 or 2 deals a year, at least in the old days, if you did 1 or 2 deals a year, that was a good pace for an investor on the private equity or kind of late stage venture capital front. And that's a lot of no's before you get to a yes. Whereas like when you're actually building, whether you had a good day or like wasted a day. And so it's kind of that kind of constant focus and constant dopamine hit. Even if things go sideways, right? Even if you kind of face a set of challenges, you address them head on, and even if you go through like a period of a grind where it seems like there's a bunch of things that's brought up simultaneously, you just kind of tick through one by one, and it's like battling the monsters on a day-to-day basis, and kind of leveling up your experience points or whatever else over time. You can kind of look back over a week, a month, a year, and I think it's a lot more satisfaction than just throwing money into a company, seeing the builders actually get shit done and make the value of that investment swell, and then you kind of sit there passively. Of course, I think investors are value added. I'm not suggesting that they're basically just along for the ride. The good ones are the next 10 years. The real shitty passive investors are all going to die, and I think every single investor that succeeds is going to be more active or have some proprietary value add. But because there's just so much capital right now. But I do think there's obviously no comparison between the day-to-day momentum you can build as a founder versus an investor. And I think that's the gravitational pull. Even if it's riskier and kind of the risk-adjusted rewards are probably higher on the venture side.
Definitely the best rewards would be the iterative incremental improvements that compound to take something, like make something unrecognizable in a medium to long term from where it started, and just the putting out fires constantly that come with building anything unexpectedly. It's exciting, it's fun, in a completely different world. You mentioned 2 investments a year from private equity funds, and I just think most crypto funds these days, it's about 200 to 400 investments a year. A lot of them have portfolios that are absolutely enormous, investing in countless companies nonstop. Again, back to that original answer you gave where you went over your background, you mentioned numerous cases where you've managed to efficiently build a team and restructure an organization to take it from a dire or not optimal place into something that was thriving. What would be the 80 for the 20 tips that perhaps most people overlook when it comes to restructuring an organization or building a team?
Well, I think first and foremost, there's never been a better time to raise capital as an entrepreneur. So the risk that you're taking financially in crypto right now, just given the amount of venture capital that's been committed to so many of these funds over the last 12 months, I think it's something like almost $20 billion now of new venture capital inflows. That's a lot of money that's getting deployed at the seed and Series A stage, and I think the key to building now is having just basically deploying some working product and taking any of the 1,000 unsolved problems that exist in the space on either the infrastructure side or the app side, and basically just kind of hacking away at an MVP and then ultimately going to market. This whole thesis of money Legos and kind of composable widgets within crypto that make it a heck of a lot easier to build than it was 5 years ago, 3 years ago, even a year ago. I think that's pretty obviously in any early stage entrepreneur's advantage, because there's less kind of in the weeds crypto and like blockchain specific chops that you need to get new services off the ground, right? Because you might be able to use a backend like Bison Trails or Alchemy or one of the hosted blockchain providers. You've got a series of tools for actually auditing your smart contracts. You've got all the building blocks in terms of decentralized exchange, in terms of lending. If you're talking about issuance, there are issuance platforms and different tools that make it a heck of a lot easier to basically just point click and create tokens almost. So it really kind of depends on which sector you're going deep into. But the one thing that I always try to encourage people to do is kind of think hard about like founder market fit. And that's something that I think is typically underrated and typically glossed over. People talk about passion a lot. Like, what are you passionate about? I think that's a terrible kind of lens to look at entrepreneurship through. Your passion should be your hobbies and what you do in your alone time. Just because you're passionate about like guitar playing doesn't mean that you should give up your day job, right? Maybe if you're like 16 and you've been playing for 10 years and you're a prodigy, go after it because you're 16 and you can afford to trip up and then get back to adulting if it doesn't pan out, right? But I think for most everybody else that's working, you try to like work your ass off early on in your career and then figure out what you're good at and kind of where you can be uniquely valuable and then kind of lean into that. And I think the companies and the teams that have been most successful have kind of had that as a kind of core understanding, core competency. Like they recognize like where they're strong, what they're interested in, and then like what the market needs. And the kind of intersection of those three is where good things happen.
Yeah, you can see the Brazilian Jiu-Jitsu book in the background. Recently started, obsessed with it, but I'm not looking to step in the ring with Conor McGregor anytime soon.
Exactly.
I like that at the end you brought all three components together, because while just purely going on passion isn't the smartest thing to do, without that passion or some sort of enjoyment, it's hard to consistently stick to that iterative process long enough to see the compounding gains. Even if you're hugely talented at something, consistency can often beat natural strengths. Well, I'd say most of the time, if you consistently do something, the compound benefits will beat most inconsistent efforts. Ryan, where I go to next would be, before we jump into the 2022 thesis, the 2021 thesis. Now, I have a few things I want to bring up myself, but from what happened, from what you wrote, and then what happened in 2021, what things were most surprising to you? What things didn't quite go how you predicted them? And what things were the least surprising from what happened?
I think the least surprising thing was that it was a big year across the board. I was pretty surprised at how explosive the growth was in alternative platforms to Ethereum. And in hindsight, maybe it shouldn't have been. Just looking at what happened to Bitcoin dominance over time and how other platforms have chipped away at that lead. But even Bitcoin at the beginning of the year, I think it was 70% market dominance. That was the most obvious flippening I think we were going to see. Not necessarily where Ethereum would overtake it, but that its dominance would go under 50%. And the other platforms that exploded, Terra Solana, Avalanche, Phantom, some of these Polygon were just kind of eye-popping numbers in terms of the market share and then kind of the base that they grew from in terms of returns. And I think it goes to show that the highest, the scarcest resource right now is not necessarily the finite money, but just finite like block space and storage capacity on these blockchains. And that's because the applications that are getting built are actually interesting and people are using them and trying to go more Web3 native. That manifested itself last year with DeFi. I think it's in turn it's been surprising how muted DeFi's performance has been this year. It's basically completely topped out, and in fact, it's been in a relative bear market compared to Ether or Bitcoin, many of the quote unquote blue chip DeFi assets. And then I'm not necessarily surprised by the rise in NFTs, but I think the pace and just like the sheer magnitude of the dare I say bubble in NFTs has definitely raised my eyebrows, because I it's always difficult to figure out like what the catalyst is going to be for growth in a given sector. And last summer it was yield farming for DeFi, right? That kind of helped solve the cold start problem with some of these decentralized finance networks, where as a user you're thinking, why would I ever use this and take on all this idiosyncratic risk for like a negligible marginal improvement in my returns, right? So I'm going to earn 4% instead of 0.25%, but in return I'm taking on like all this excess technical risk that comes with crypto, and then kind of yield farming juice those returns by giving people ownership in the networks that they were helping to bootstrap. I think same is true with some of the layer ones this year. You started to see kind of compounding interest as like gas fees went higher for Ethereum. And once people realized they were going to be persistently high, more activity and more speculation flowed through to these like layer one chains. And then in turn, that basically led to an explosion in infrastructure and kind of developer interest, because people collectively knew because of the size, there's going to be investment opportunities, because of these investment opportunities, there's going to be staying power and so on. I think with NFTs, it might have been a little bit simpler than that. It might just have been like the wealth effect, on steroids, because there's so much money was made in the back half of last year, especially, and then in Q1 of this year, that investing in things like digital art or profile pictures or some of these like more social, kind of mimetic, like artistic experiments, it started to take on a life of its own. And I think that trend, I don't know kind of where we are in the NFT cycle, but I think that has brought with it investment in kind of the underlying infrastructure for NFTs to kind of get to the next milestones. So basically you have this like accelerated hype cycle curve that happens across crypto, but now it's starting to jump from like sector to sector, right? So like maybe we're not ever in a like all things are in a bear market type of environment. Not that we won't have bear markets, but they might just kind of overlap, right? So right now we're arguably in a bear market for DeFi, NFTs, and like the metaverse have been booming. We've been in a relative sideways market for Bitcoin and like money like cryptocurrencies, but like layer one computing platforms have exploded. Do we think that's going to reverse next year? Do we think that those kind of narratives have staying power? Your guess is as good as mine, but I think that there's going to be like an ebb and flow between different components of this economy. And because of this venture capital backstop that now exists, going to my kind of previous point, it's hard to imagine like the entire industry falling off a cliff, because there's like US dollar denominated permanent capital basically that's going to be deployed in during pullbacks and into like winning teams and winning infrastructure and application plays. I think there's a lot there that I wouldn't necessarily say surprised me when you're taking the long-term view, because I'm probably a permabull on the rest of the industry. But I think that the details and like exactly how money flows and how returns flow from asset to asset, sector to sector during bull markets especially is that's if you can predict where the hot ball of money is flowing next, obviously you do really well in these types of environments.
So I'm glad you ended on the exact point I was going to come back in on, and I'll get to that in a second. Absolutely love the take. I mean, you covered everything I had down. The DeFi blue chips underperforming, NFTs overperforming spectacularly, the increase in the stable coins, and the alternate layer ones, I think it's very much linked to the explosion of NFTs. I mean, people wanted a scalable use case quickly, and also Ethereum wasn't really keeping up. How much do you think the explosion of layer ones was simply because it wasn't cheap and accessible for most people to use these new features which were coming up? Even DeFi to some extent is pretty inaccessible to most people on Ethereum, is why Solana, Avalanche, and all these other layer ones have been blowing up.
I think that's 100%.
Fantastic. And
yeah, I mean, I think that if Ethereum fees were in the pennies, and you had people that could access yield farming and some of these decentralized financial applications, or even like new NFT mints, and it didn't cost tens or hundreds or even thousands of dollars to participate, then I don't think we would have seen the alternatives explode this year. So the big question is whether we think that the introduction of like different layer 2 blockchains that are EVM compatible take back some of that growth and that narrative and kind of eat into the alternative layer 1 communities, or whether we kind of live in this multipolar world basically between the EVM and EVM compatible blockchains and maybe one or two other standards like Solana.
Yeah, that a lot of ambitious projects out there right now trying to put all the chains, combine all the chains, and really solve some potentially huge issues with by combining liquidity on decentralized exchanges between all the blockchains, and that makes someone who doesn't combine liquidity almost not able to compete with you. So you also mentioned how powerful it is being able to predict a narrative before it happens. I'm going to push back a little bit there. Given how inefficient crypto is as a whole, and how slow sometimes it feels for the market to react to trends, do you even need to predict it? Can you not just watch the trend start and then come in after it started and, not sell the top, but ride the trend for a little bit and try and get out? Throughout 2021, it's been such an effective strategy to just come in after, or as they meme on crypto Twitter, buy high, sell higher.
I think that's true in a lot of financial markets where momentum traders have done very well over the course of the past 20 years. It's one of the tried and true trading strategies that I think works. I'm not a trader, right? So I've got a kind of barbell approach between angel investing and then Bitcoin and Ethereum.
Sorry to interrupt, Ryan, but I don't want to move on from that. Please, could you tell us a bit more about your barbell approach for anyone who isn't familiar with Nassim Taleb's work?
Mine is very it's pretty basic. It's just that I'm focused full time on building. So like most of the personal value that I'm going to generate is going to be through my company equity as the founder of a growing startup, and the distractions of kind of like full-time trading and playing the market, you basically have to make a trade-off. Some people are able to do both, I guess, but I've focused all my energy on scaling Messari, and that means that I'm not going to be a very effective trader because I'm just not monitoring this stuff day in, day out. And when that's the case, it's good to be in the top blue chip assets and be more of a buy and hold investor. But if you want to capture all the upside from the explosive growth at the kind of early stage, and you look at what some of these smaller cap tokens have done this year, they've gone up 50, 100, 200x or more. One way to kind of get that outsized exposure versus the top market cap coins is through angel investing. So because I have been around for a while, I have a good network, I typically just invest at that stage as well. And it's easier to buy and hold when you're kind of getting into something that's like a $15 million or $50 million valuation versus a $2 billion valuation. You're trying to, kind of play the mid-market game, figuring out which assets are going to rally. So it's more of like an attention thing and a hack for me than, something that I would necessarily recommend to anyone listening, because those private market opportunities are network driven versus like publicly accessible.
So what advice do you think it's a realistic goal for someone to try build their network and value add in the space to the position at this point where they can get access to this network and those sorts of opportunities? Or do you think it's low ROI on time type of play?
I think the only way that you really do that is if you're building, right? So I think the bigger value add and the bigger economic opportunity for most people that are getting in is just to either contribute to or build startups, right? And there's so many companies that are hiring right now. If you want to develop a reputation and network, just join somewhere and kind of get into the trenches. It's going to be the fastest way to learn. You're going to get paid to learn. You're going to get paid to build your network, depending on what the role is. So I think, and for 99% of people, the path to, actually doing well financially within crypto is going to be by increasing your earnings power, not by, riding a massive bull market to another 100x, right? The folks that made 100x were in last year. You can't kind of go back in time to the beginning of the cycle. And it is overly optimistic to assume that trend is going to persist, right? We'll have another bust. We'll have maybe several other busts. Things will cool down, and then it'll be more interesting to get kind of full-time, into kind of deploying capital in different liquid markets. But, your guess is as good as mine for when that actually happens.
Yes, although I'd say your guess is definitely at least a few percent better than mine. If mine is 4%, I'll give you at least 12%, Ryan. Well, it's 30 minutes in and it's just too interesting. Everything you say I want to dive into and learn. Thank you again for the opportunity and coming on. Let's dive into the 2022 thesis right now. One of my favorite things in the entire thing was your top 10 list, as I'm sure it is for a lot of people. Huge congratulations for you. And this is where I'm just going to hard chill Messari and the report to anyone listening to this podcast. It doesn't matter if you're a beginner or advanced. Ryan, I don't know how you do it, but you write it in a way where you don't overcomplicate anything. And that's probably from your deep understanding of everything you write about. But I feel I could give this paper to anyone. Someone who's completely new to crypto, maybe a little bit of basic understanding, or someone who's very advanced in the space. And it's going to be hugely beneficial, whoever you are. So huge congratulations to you for being able to word something like that. It's spectacular, and it's going to do wonders for anyone reading it. And if you guys do enjoy it, check out Messari as well. So in your top 10 list, the first 3 points you made kind of had this overarching theme of moving towards user-owned economies. Your first one being increased distrust, increased institutional distrust. Now, practically, what sort of signals should we be on the lookout for that will further accentuate and bring more people in crypto, in terms of like what signals that confirm this narrative that distrust is growing and we really are moving in that direction?
Well, I don't think you have to look far or too hard. I think this has been something that's been building for a long time in the West in particular, right? This distrust in institutions. And the graphic that I point to in the report is from a survey that Edelman had run, and basically showed that on two axes, competence and ethics, no modern institution ranks in the upper right quadrant that's both ethical and competent. You have businesses that are viewed as competent, but maybe slightly below the axes in terms of ethical. You have NGOs that are viewed as ethical, but maybe not as competent. And then you've got like media and government that are neither competent nor ethical. And like government and media score, in that kind of dreaded like lower left quadrant. I think, market-based solutions and software, because it is apolitical and it's automated, those systems could conceivably replace trusted institutions, because I think more people will trust math and code over time, especially math and code that comes with tokens which can coordinate and align incentives. So I think the big opportunity that people have identified, really talented people are getting excited about Web3. It's that the design space is wide open, and we've kind of gone from 0 to 1 already in de-risking crypto as an asset class and as a technical movement, right? So I think it is intuitive to people that owning the networks that you participate in is a better model than basically being rented out by Facebook or the big tech companies, or basically being the rent that's extracted by Wall Street every single time you do a financial transaction. I think those things kind of resonate with people in general. And after they get past like the volatility of the underlying assets and just the word crypto, right? So I think most of the talent that's coming into the space right now, in design, in like professional finance, in like Web 2 tech, people that are really kind of at the bleeding edge, that have had their eyes kind of open to the opportunity set. That's I think that's what attracts them. It's could we basically build a better internet and better marketplace infrastructure so that the world is a little bit flatter and people actually own the services they use, and the kind of future of the economy is a little bit more democratic and user owned instead of institutional owned. Now the criticism there is, well, are the new rulers going to be the same as the old, just with more of like a tech bro tint, right?
Why are you asking my questions for me, Ryan? This is my job. That's exactly what I was going to ask. Please.
Yeah, and I think the answer is we don't know yet, and I think it's kind of incumbent on us as the kind of leaders, the builders within this new economy to maintain like the moral high ground. And I actually just did an interview with 𝐉𝐨𝐽𝐬𝐬 a couple weeks ago, right around the launch of this report, and I actually interviewed him because I think he's one of the more thoughtful people, if not the most thoughtful and insightful mind in our space. And he kind of broke this down as like the moral stack, which is how do we win hearts and minds? Like how do we kind of win this political battle, and how do we get people to like accept the potential here for good and not just see the dangers and kind of the negatives. And I don't think that's a foregone conclusion right now, especially during like the top of a hype cycle, because money seems to cloud people's judgment. We know that throughout history, but will we find a way to persist and kind of get past some of those growing pains and kind of the speculative mania, and actually convince people that this is a good thing for society, for the world, and here's why. Here are the kind of 4 or 5 reasons why. Because at some point, our answer, while everything else sucks, is not going to be compelling, because you've seen what happened in Web 2 with that answer, right? Yes, like the Blockbuster was an inferior product to Netflix. Is it good that we're binge watching Netflix 5 hours a day, right? Maybe not 5 hours a day, but you know what I mean. Some people do. Is it a good thing that people are more connected than ever before? Yes, but that leads to all these other unintended consequences that we've seen with Facebook and Twitter and just kind of just general social unrest, or kind of exacerbating some of the tensions that we have. And I think there are ways to better align incentives and keep people, keep a long-term orientation here. It's going to take a little bit of discipline, and I think the volatility in some respects is a gift, because it's not a straight line up. We have these cycles where the people that come in are here for the quick gains, and then 10% of them stay during the bear market, and that kind of creates like the higher low in terms of the people that are building, the people that are really trying to lay the foundation and kind of build the values, embed the values of crypto kind of throughout all the products that take root. So I remain optimistic, but it's not a foregone conclusion that we win the kind of mass market and cross the chasm to mass market adoption. If anything, NFTs are probably the biggest catalyst that help us cross that bridge, because most people don't care about DeFi. They don't care about processing transactions on the EVM. They think that Bitcoin is weird, or that it's going to be dystopian if a money like Bitcoin takes the place of fiat currencies that are more stable, at least on a temporary basis. So I think NFTs are a big opportunity in that regard, and we still have our work cut out from a messaging standpoint.
Another incredibly insightful answer. I mean, the negatives that come with any technological advancement. Recently reading *Sapiens*, you can even argue the transition from hunter-gatherers to farmers was terrible for us, and the worst thing we ever did, and our quality of lives are still bad, worse than they were over there, but then we never moved forward. So that's another debate for another time, whether it's about aggregate happiness or progression and what we should be focused on. The other issue is, like, you mentioned that this is having these sorts of decentralized networks is fantastic because of the transparency, and it's all rooted in mathematics, and it's all there for people to see. But most people, at least this is not backed by data, but I think most people would agree that most people won't fully be able to understand the intricate dynamics of what goes into creating these systems, and will have to rely on interpretation from what people project out to them or tell them. So it's just another game of politics. But again, you did make that point that you can't just argue that they're both bad, therefore do none of them. There are lots of arguments that just that transparency alone makes this superior in some way to the previous system.
As the crypto industry continues to mature, it's natural that more and more wealth-building platforms will arise. The problem with many of these, however, is that they are often so complex that it disincentivizes people from using them. This is why I've partnered with Nexo, one of the top crypto lending platforms in the world. With over 1.5 million users and 15 billion assets under management, Nexo combines the yield-earning features of crypto with the familiarity and ease of centralized finance. Nexo allows you to earn interest at a competitive rate on crypto and fiat. They also allow you to take out loans using crypto as collateral so that you have access to cash without needing to sell your investment. You can even trade directly on the web platform and mobile app in an intuitive and secure way. If you're looking to embark on the journey to financial freedom whilst minimizing time and frustration, I highly recommend you check them out by visiting nexo.io. That's nexo.io.
Where I'd move on to next, and you did touch on this, was with regards to companies like Facebook and Meta coming into the space. Like, we've got a very loyal and big crypto community, and you said one of the most important things is for us to push our values forward and do this thing right, per se. But how can this community compete when the existing giants try to come in, like Meta? Like, what power does this community have compared to Goliath like that?
I think institutional inertia is, throughout corporate history, it's and history in general, it's very difficult to pivot an entire business. And particularly one where you're going to cannibalize your own revenue. So this is like the innovator's dilemma, and what's his name from Harvard? I'm blanking on his name. Christensen. I don't know why the name is eluding me right now. I'm tired. It's been a long year. But the Clayton Christensen. I think the general theme of startups is, if an incumbent can beat you at your own game, you don't have a really compelling business. And what I think about with Web3 as an unfair advantage is they are starting with a complete polar opposite approach to the Web2 incumbents. And that is, we are going to make every single one of our users, especially our early users, owners in these networks. So you're basically encouraging early users to defect from the legacy platforms, and you're giving them real financial incentives to do so, and not only real financial incentives like $10, but like multi-level marketing incentives where we're going to give you $10 today, but if you help us grow this network and invite your friends, that $10 could become $100, $1,000, $10,000, $100,000 because you were here early and you basically helped us siphon all the demand away from the Web 2 incumbents. And now as we find that business model, whether it's token-based or ad-based or whatever, the rewards are going to get distributed to the user base. And essentially the stockholders of Facebook, which were like the venture capitalists and the principal investors in the private markets, now they become the end users of a given network. And I think you're still going to see we're already starting to see like crypto funds like play in those liquid markets. But it is different because there's an entire pool of capital that's going to go to users and employees that historically went predominantly to the investors and maybe a little bit to the employees. And so you're basically kind of turning the value sharing pyramid on its head, where it's users first, contributors second, and then the kind of speculative investors third. And going back to my kind of former comment, the speculative investor is not going to be passive, right? So they're very frequently going to be like some combination of like user and contributor. It's such a stark change in the approach to building a business, and you are incentivizing like a narrow wedge of users that Facebook is never going to go full Web3 before a Web3 native social media play, because most of their revenue is still derived from suburban moms that are 40 to 60 years old. That is not the early stage demographic for Web3. Like they are not going to grasp that regardless of whether Facebook rolls out that solution or not. They're going to be a little bit later to adopt those solutions, just statistically, right? We know that from the demographics that we already see within crypto. So I think even if these big incumbents want to go where the puck is moving, it's going to be extremely difficult for them to do so. Ironically, Meta is probably one of the platforms with the biggest opportunity because they can take this piecemeal approach and kind of disrupt themselves gradually. You could start maybe with Oculus, right? And WhatsApp and Messenger, these platforms that haven't really been monetized yet already. And then like the Blue app, Facebook proper, is maybe the last to adopt and to adapt here. And Instagram, maybe the last to adopt and adapt. And I saw a good quote from, I think it was Matt Wong from Paradigm, wrote something about the kind of digitally native social networks versus the real life social networks, right? So you think about like Facebook, it's sharing your real life updates. Instagram, it's sharing your real life pictures, versus like Twitter, it's like all of your virtual communities. Reddit, it's like an entire virtual community. And I think there's something real there. And what's interesting about Meta is you kind of have the same split within their products where like it kind of goes back to what I said. Facebook doesn't need to be disrupted and go Web3. Instagram doesn't necessarily need to be disrupted and go Web3 because those advertising models will work. And I don't know that their end users are necessarily Web3 natives. Oculus, like there's literally people living in the fucking metaverse. So if Meta is going to build the hardware to actually make the metaverse and like AR and VR more real for more users, and they're predominantly going to be younger users to start, that's a perfect place to embed like Web3 type incentives. I think I think Zuckerberg is a genius. People will debate like whether he's a good corporate leader or whatnot. I don't think you can argue with his success and his kind of vision and ability to execute. Just if you look at how he's done with M&A, but I think because he is insanely intelligent and ambitious, the smart play with Oculus, for instance, and the VR play is to embed user incentives from day one. Because if Oculus just becomes this like dystopian, like Wall-E type of like corporate sponsored, you know, ads only like world, and it looks like an amusement park for like corporate greed, no one is going to play in that like virtual amusement park. They're going to go someplace where it's more wide open. It feels more like the frontier. They don't feel like they're being like monetized and sold to. So I think just from a viability standpoint, Facebook will be able to make money from the hardware and become more like Apple, right, as they continue to scale Oculus. So that's one revenue stream. And then, do you want to build a platform that's more like iOS or Android? And I think that will be the more interesting decision to see which direction Facebook goes. Because if they go, there's pros and cons to both, right? If they go I actually think a hybrid would be best, because if they go Android, then they're basically saying, okay, we're going to try to lean into our ad-based business model. If they go iOS, they're saying we're going to take these large rents. And really, the answer might be somewhere in between, where it's like an Android-like open platform, but we're only going to monetize it on like an opt-in basis or by selling other virtual goods. So it's almost like they opt out. They create the same type of marketplace and platform, but they go more towards how like the gaming giants did the last like 5 to 10 years, which is they lean into the sale of virtual goods, NFTs, like, you know, iOS level opt-in marketplaces where you can kind of go through the Oculus store, and these are like the curated, vetted third-party apps and places to go and people to see. And in return, probably not 30%, but we'll take 10%. And I think, you know, users all day long will opt in for that type of model. So the pie that they can potentially eat from is orders of magnitude bigger than if they fuck it up and they try to create this like ad-driven experience.
Ryan, Facebook should hire you to restructure.
Yeah, that's one area that I don't think startups can compete. Like, startups cannot deploy $10 billion a year into hardware investments, like full stop. So you want and almost like need Facebook to emerge as one of those key players. And then like the software is where I think, you know, people will compete, but not necessarily the graphics or like the development of the hardware infrastructure needed to power those.
Yeah, roles. Firstly, Facebook should hire you to as a consultant or to restructure their team. That's the best answer I've heard to that without contest. Can't tell you how much I appreciate you on Ryan. You also mentioned the very compelling argument of like there's this new paradigm where the user-owned economy is like, it's so much incentive to move away from the existing giants that it becomes hard to value this or even fathom like how much this stuff should be worth. And something I'm noticing and seeing right now, which goes into your point on venture capital in the thesis as well, is that valuations are getting insane. Companies with just an idea and no product are raising at 500 mil plus valuations right now. I mean, it feels like a top signal, but is there any argument against this being a top signal? Could it be that things are just valued more now because users can have ownership of them, and this is just the new stage of the world in companies?
I think the thing that everybody misses about crypto valuations right now in the private markets is that the time to liquidity is extremely compressed. So first of all, if you think about like a blockchain infrastructure company or an exchange, those services are making tremendous amounts of money, right? Like 9 figures to $1 billion a year in either like staking rewards or transaction volumes, just because of like how much activity is ongoing. So like there are infrastructure companies that are raising at like eye-popping totals, you know, Fireblocks, Anchorage, Blockdaemon, you know, Bison Trail is a big acquisition from Coinbase. I think those businesses all make sense. And they're making a ton of like revenue by providing like picks and shovels to this economy. Then there's the token plays. And you talk about like, okay, like a seed stage startup, like a gaming company raising like at a $500 million valuation. That's insane if you're holding for like 7 years and you know your time to liquidity is going to be like 7 years, because you're just taking so much idiosyncratic risk along with market risk and, you know, the fact that things could cool off next year. But if the time to liquidity and the time to actually distribute these rewards, even if they unlock over, you know, like a 36-month period or whatever, so you're still taking some timing risk, you know that there's a not insignificant chance that that investment could be marked up 3x in maybe 6 months. So even if you can only take a third off the table, if you want to, for like capital planning purposes, and kind of risk management purposes, then that you basically get paid back, and now you're playing with like a free lottery ticket. So I think people often lose sight of the fact that because these are liquid markets very quickly after they're illiquid markets, you can juice valuations when the public comps within crypto are sky high. There's two ways to value companies, right? There's like the fundamental, like historical discounted cash flow type analysis, and then there's comps. And most of tech trades on a comps basis, because you're basically looking at the 5-year, the 10-year earnings potential and value creation potential, not necessarily like where the company is today. And you're basically just making projections about growth and potential market sizing. So I think if you look on a comps basis plus time to liquidity, that's how you can get to these numbers. I personally don't invest at that stage, because for a few different reasons. I like I said, I'm more patient and can go earlier stage, number one, and number two, I just it creates, I think, some personal conflicts if I start to get into flipping tokens while running like an information business that could potentially cover those tokens as well. So it just makes my life easier to buy and hold.
Do you think there are, say, someone who has no sort of informational company or association with the public, just a venture firm that's working on the back end, raising money at that 500 mil valuation for just an idea where fundamentally it becomes, you can only really justify it through the public's demand to just buy it with the same hopes of flipping it for higher. Is there any issue with companies continually just raising these valuations purely based on demand and raising more and more money?
I mean, I don't think that there's any issue. I mean, you take the money while it's there, especially if it's if you're not diluting yourself too much. But for early stage companies, you can create some kind of wacky incentives if you raise too much too early, because now the expectations for you to actually realize some like liquidity events or like some value creating event for your team and your investors, like the stakes are much, much higher, because you just need to grow into a valuation that the public markets or some acquirer will be able to support. That's a high class problem to have, but I don't think it's a complete non-issue if the market turns, right? So again, I think founders is the same calculus. Are you going to be coming to market relatively soon with a token, for instance? And again, do you think that these kind of valuations are fair and sustainable? Because I don't think that the kind of late stage private market investors are stupid. That they're taking maybe a rosy look on the future of Web3 over the course of the next 5 to 10 years. But again, many of the companies that are getting these really eye-popping valuations, they have real hockey stick metrics and real value extraction like business models that investors think are sustainable. So I think that's the same calculus is true as a founder as is for a venture capitalist.
I know that's a touchy topic. Thank you for the answer. Ryan, I know your time is valuable, so we're moving on to the last section covering how high we can fly and the coming crypto winter. One of the quotes you mentioned, which I absolutely love, was the time to go all in with crypto on your balance sheet was last year. I'd be more cautious here, 10-year and 10-hour thinking only. To put this into like something tangible, could you give us an example of one good 10-year play and one good 10-hour play? Even if you don't want to give a current one, an example of previous ones, just so people can perhaps replicate that same framework.
Yeah, I mean, I think Bitcoin and Ethereum are the 10-year plays, right? 10-hour plays. Like I said, I'm not a day trader, but I guess my point there is I wouldn't be married to any position whatsoever, whether it's in DeFi, whether it's in NFTs, another layer one platform. I just think, the market could go either direction right now, and what goes up must come down, or what goes up and what gets realized must get sold to pay for taxes is maybe the other way to look at it. So like you are going to have some selling pressure from people that are taking gains and paying taxes or paying distributions if you're talking about the investment funds. And I think, the question is, will the incremental new investors be enough to offset that? And it seems like we're kind of like in this like temporary battle between bids and asks. And it's essentially just like a rotation of capital to a new set of buyers and holders. So I don't think it's necessarily bearish, but it's not like we're just on this continued parabolic move north. And I don't think that there's anything that's like a screaming bargain right now within crypto. I'll put it that way. Could we go higher? Yes. Could we go lower? Yes. So think about where you expect the industry to be in 10 years and kind of what your long-term thesis is first and foremost. And then I would say for most people, it's not, thinking through which speculative investments you might be able to make, but again, like where might you be able to build and like where might you be able to add value as a full-time participant, because getting into crypto full-time as a career is a better path to value creation and extraction than just trying to play the ponies and out-trade some of the professionals.
Definitely when it comes to trading, like I think it's way easier, more rewarding, and better, higher probability of success becoming a builder than a day trader. But for those in other industries, passive investing with a long-term vision, with managed risk, is a great approach as well. And for the longest time, I've been using, like you said, Bitcoin and Ethereum and treating that as almost an index basket of the whole market because it covers such a large proportion of the market. But you've mentioned how crypto really is decoupling. For how much longer is that going to stay the play that gives you exposure to the entire market? Are there arguments even now that it doesn't give you complete exposure to the whole market anymore, and there are other places you need to look for getting that index all-encompassing exposure?
I don't really know of a better index play right now. And the problem is that the constituents of like any index will change if you're talking about like the top 10. Do you really want to own the top 10 right now? Probably not. Do you want to own all the layer ones? Maybe, right? Do you want to own a basket of all of the DeFi blue chips? Maybe. So, I think we're going to start to see more of those. And I think the market will kind of satisfy that demand. But, where things go, in terms of like performance, outperformance, underperformance with just Bitcoin and Ethereum proper, it is hard for me to envision a scenario in the medium term where if crypto succeeds, those don't do very well. I'll put it that way. And likewise, if crypto faces a winter, those will likely be the two most resilient assets. And then you kind of reset expectations and kind of figure out what's actually built to last. Amidst the wreckage, and we kind of go through maybe a smaller version of what we saw in 2018 and 2019 in terms of like finding hidden gems and teams that were actually continuing to build and continue to iterate them in the right direction. But we're still a ways away from that. And like I said, I think that the addressable universe of projects that are going to be long-term interesting to professional investors. Even during a dip, it's probably 2 orders of magnitude broader than it was after the 2018 bear market.
It'll rhyme, but I doubt it'll repeat exactly the same. Ryan, I can hear the screaming kids in the background. I'm definitely going to let you go. Final question of this podcast. Ryan, this is one I'm personally curious about, and I know because you're all in on Messari, which everyone needs to check out. You may not even have investments outside of crypto, but is there anywhere you look to outside of crypto? Is diversification of just your assets? Because even if you're all in on Messari, you're going to have assets that you need to put somewhere. Do you ever look outside of crypto?
Not at this point, except for real estate and cash. So those are the 3 assets that are of interest to me. I don't really see the marginal value of a stock portfolio. If the bubble pops in the low interest rate environment, then growth stocks are going to suck wind, and we're going to have a period where things go flat or slightly negative. So in that environment, I also think that crypto likely corrects. but there will be much more early stage opportunity. And my personal mix will just kind of go to emerging projects and emerging teams that have caught lightning in a bottle and are solving real kind of pain points for the industry. So it probably goes, the most conservative would be if we had a blow off top and I moved, a good chunk of my assets to cash, on a temporary basis, just to kind of de-risk a little bit and yeah, sure, kind of combating inflation. But at the end of the day, if things get really wild, you might be perfectly happy sitting in cash for a little bit, just to kind of see which direction the market goes. So not investment advice, of course, but how I'm just thinking about my personal book.
Ryan, this has been an honor. I really hope you've enjoyed yourself and we can see you again on the podcast in the future. Thank you for taking the time. Meditators, that is all from us. I hope you enjoyed this episode. Listen to it again, take notes, and we'll see you next time.